Welcome to another edition of the Nebraska Soybean Board Weekly Market Roundup, being brought to you by Nebraska soybean farmers and their checkoff. It's going to be interesting. If anything of the pre-show discussion is anything what our show is going to be like, and we're going to dive into a lot of great information. And we know that we're going to talk about USDA and the China policy. What happened in this cattle complex this week? How crazy were these prices? But what's the open interest as well as we look at the wheat and the bean movement and a lot more. So stick around. More's coming up right after this.
It may be small, but this little bean fuels power. It powers a food industry as a source of protein. It's a fuel that powers diesel engines while reducing emissions. It powers a state economy and bottom lines. And it powers the rest of the world as a top Nebraska export. Yeah, it may be small, but we're finding more ways for this little bean to power Nebraska.
And welcome back once again. As you can see, joining me is Kyle Bumsted and Mike Zuzolo. Both these gentlemen are going to really dive into what we've seen in the market trade. And so I want to start out just talking about let's jump into the geopolitics of it. Unfortunately, Mike, what's happening with China and the USDA. There's some policy that's being discussed within the trade.
Yeah, and this kind of dovetails with what you and I talked about. And by the way, on channel Final Bell yesterday, it's great to be with Kyle. I really enjoy being with him every time we do this. And, you know, Susan, to me, this week's market was bookended. It was bookended with the USDA report showing strong actual demand for the grains, especially no backing off due to tariffs. In fact, we saw exports and ethanol increase for corn. And then the second other part of the bookend was the end of the week and this Chinese economic policy. And the market was very highly tuned into that, and in that they were expecting China to decide to stimulate their domestic demand. And China, as much as we can tell right now, Friday afternoon, has decided to stick with the plan of exporting their way into their growth market and in terms of keeping the growth strong. That's probably not what President Trump wants, because if you're going to rely upon your exports, you're going to keep your currency weak. And if you want strong perceived demand by the funds so that they buy into the commodities, especially given our inflation numbers this week for the U.S., you're going to need China and you're going to need the domestic consumer, because they're actually in deflation and their producer prices have been down almost over 2 straight years, you know, month after month after month consistently. And I really think this is starting to weigh on the markets. And I think that's what I pulled out of the market as we closed out Friday. Was we started to slip midweek. The Chinese news did not do anything but hurt us. And I think we just had long liquidation. Was there any damage done? I don't think quite yet there was.
Well, you know, we also saw the fact that we had unknown purchases coming back in for both the corn and the beans. So what is your thoughts on that, Mike?
Yeah, I mean, real quickly, I really am nervous about the weekly export sales numbers, and those unknown sales are great, but I think we have to wonder whether some of this stuff's going to get canceled. And the over 500,000 metric tons of soybeans net reductions, I didn't like seeing on the weekly export sales. And so I do think USDA's numbers, after looking at everything they put out this week, would suggest China probably has extra beans they bought, and Mexico has extra corn. And that's kind of how I'm playing it with the clients and subscribers.
Now, Kyle, we and you and I have had this conversation, how crazy it is with this cattle market this week. And who would have ever thought we would have been passing on 197 and 305s as the week came to an end?
When we went home, things didn't look good on the charts as far as the technical picture. We did see a pretty sizable sell-off there last Thursday and Friday, and somewhat the same action here this week. But we did see higher cash trade last Friday, and that's what kind of opened the board higher on Monday, and we just kind of took off and rallied here for the rest of the week. Now, we, as you did say, we did pass on some 305 and some 306, 307 cash trade. I do know some cash that traded on a dress basis up as high as 312. I don't know the quality of those cattle, but a lot of 192. There was even some light 193 getting traded there in Kansas and Texas here. We also saw 196.7 and 198 trading here in the north in Nebraska. And, you know, this is great. And I think that the December futures are going to have to come to cash, or cash may possibly come down to those December futures here. We've got a couple of weeks for that to happen. I know a lot of producers are getting kind of stubborn up at these levels and just saying, nope, I want more. And that's fine. But when this ball stops rolling, it's going to crash fast. I mean, we've gone up in an escalator and it will be straight down in an elevator when this thing topples. And I know a lot of folks are watching that box beef, and it's been very erratic here. But I also want to point out something that's very interesting here, as I think is kind of erratic. It doesn't matter if cattle are higher or cattle are lower. The open interest continues to grow and grow and grow in this complex in both the live cattle and the feeder cattle. And these non-commercial funds, they've got a foothold here, and they keep adding that position. So just keep in mind, if they want to take their money, they can hit the exit faster than the producers can get hedged up.
So did it come as a surprise how fast they closed those gates per se when it came to passing on the bids?
Not really, because once the bids started kind of surfacing in Nebraska at that 193, 94, the guys up here in northern Nebraska, they started locking the gates and saying, 196 might do it, and then 196 wouldn't do it. And I know some folks in eastern Iowa. There's a major plant out in Illinois, a Tyson plant out there that they started. They kind of said, well, what's it going to take to buy them? And they said, well, let me see what it's going to take. And lo and behold, they called back and said, how many can we get? How many loads can we get at that price? And so they said, well, we want them, and we want them now, and as many loads as you can send. So that's probably a good sign for demand. But as Mike was kind of talking about beforehand here, these cattle on feed numbers just aren't matching up here with our weekly production and the slaughter pace and things like that. So I think that's something here as we move forward. And just before this broadcast here, about mid-session here on Friday, there was some emails out about potentially opening the border back up here to take in Mexican feeder cattle. We import about 30,000 head of those feeder cattle each week. So, roughly about 120,000 head a month approximately. And, these are 3 to 7 weights, and they've got a ways to go. But all those cattle have been backed up down in Mexico for about 3 weeks now, and they are going to probably come across the border.
So open interest, as you look at that big picture, let's kind of rehash what you were talking about before we started recording today's program.
Yeah, the open interest, like I said, it doesn't matter if we're higher or lower. It doesn't matter. The open interest just keeps growing and growing and growing in this live cattle and feeder cattle complex, and to a lesser extent the hogs too. And that just tells me that these non-commercials are pushing this thing, and this balloon keeps getting bigger and bigger and bigger as far as the managed money and the funds, algos, whatever you want to call them, keep pumping money into this thing. And that's a little bit nerve-wracking because they're holding a huge position. Now, it wouldn't surprise me if they're at record long or near record long here today on Friday when this commitments traders report comes out. But the real one's going to be what happens here as we square up position here next Tuesday. We're getting into some holiday type trade here about the middle of next week. Things are really going to start to slow down because the following week we've got Christmas, and the week after that we've got New Year's. So it would not surprise me if some of these funds want to take some money off the table here before the holidays.
So, Mike, what's going on with the European Union and their wheat?
Yeah, the European Union with the wheat market is trading about $6.50 a bushel, and so you're talking about U.S. dollars a dollar bushel higher than where we're at, as far as we're at $5.50 roughly with the March now lead month futures, and EU wheat's $6.50 a bushel. And I think this is important from the idea that a reason why I think the wheat couldn't help the corn, and I think this is a big deal. The corn market is now only 96 cents discount to the wheat, the soft red wheat. The wheat's a feed grain at this point, and we need to change that structure. We're going to start leaning on the corn, I think, through the wheat market if it can't rally. And that really goes back to Russia, and it really goes back to the European wheat prices. And so I'd like to see in the next couple of weeks a real shift by Russia. USDA did not lower the Russian production, but they did lower their exports a million metric ton. That surprised me, Susan, and I think that's a real issue to have to keep watching. I still think wheat is our leader in the corn overall big picture.
We only have a couple short weeks before 2024 is over. So I wanted to get both of your takeaway thoughts of what we need to be doing, whether it's livestock or on the grain perspective, to maybe be in that right marketing mode and frame of mind going into the new year. So Kyle, I'll start with you.
Well, I think we need to take a look at the volatility in the feeder and the live cattle options. Volatility is very, very low. It has been low for several weeks, months. And I think if these producers are loading the arbs of some of these higher dollar feeder cattle, there's probably some options out there that make sense as far as protecting an all-out catastrophic black swan failure. Now, I know that everyone says, well, I don't like buying options, but it's more of a volatility type thing. There's not a lot of volatility there, so you're not actually buying a lot of extra volatility in these complexes right now when you look at it. And I also think that if this cash cattle market were to break, you're going to see feeder cattle drop in price because let's face it, in order to get these cash feeders to have a decent setback or a sizable setback on the cash side of things here, you're going to have to take a beating on some of the cattle that are walking on the truck right now. That's the reality of it. Guys are making money feeding cattle right now. As one guy says, big cattle, big check, and the bigger they make them, the bigger the check. Well, when that ball stops, that's when cash feeders are likely going to stop, and that's when the board could come tumbling down.
What about you, Mike, from a grain perspective? What should we be thinking about?
Yeah, I'm like Kyle. I'm the cycles for me are suggesting fat cattle high in early 2025. I think that's going to take the feeders down with it, like they did in 14-15. For me, the soybeans are still the leaky hole in the leaky bucket, or the hole in the leaky bucket. I'm really nervous about 2025 November beans losing that $10 handle and being closer to $8.50, $9 a bushel if we don't have weather issues. And Chicago colleagues I talked to are suggesting the same thing. I think the third thing I'd throw out there, Susan, is I'd be watching very early 2025 for a top in Wall Street, specifically the S&P 500. Not a securities brokers, but those funds have been playing in the cattle market big, in my opinion, in part due to Wall Street. So looking to sell into that S&P mini in early 2025 as well.
Well, gentlemen, I appreciate it. You both being on the show for me this weekend. I know you're going to be on a daily between now and Christmas joining me, but for this program, I want to wish both of you a very Merry Christmas and look forward to talking to you on this program in the new year.
All the blessings to you and the great listeners out there. And thanks, Kyle, and Merry Christmas to you guys.
Thank you. Merry Christmas to you as well.
Well, quick reminder to everybody, commodity futures and options do involve a substantial risk of loss, not suitable to all investors. And information on this show is provided for educational purposes and is not intended to influence legislation, government policy, or action. And that's another episode of the Nebraska Soybean Board Weekly Market Roundup.